On the podcast with us today is Jennifer Barner. Jennifer, welcome to the podcast.
Thank you. I appreciate your time, and I look forward to talking to you today.
Awesome. Well, before we dive into this acquisition, this was a 72-unit apartment complex called Arbors Apartments located in Northwest Arkansas. You closed it just a few weeks ago, so we're talking January 19th, 2021, and you closed this property a few weeks ago on December 30th at the last minute of the day at 4:59 p.m. So before we dive into that acquisition, because I know we're going to talk about a lot of different things that kind of happened on that acquisition, but before we dive into that, why don't you share with the listeners a little bit about yourself and your background and kind of where you are right now as it relates to the multifamily side of things?
Okay, happy to. So I began my real estate career in 2015. I was introduced to the Rich Dad program and thought that I kind of got gypped in college because I'm a finance major and never had been exposed to real estate at all. So I was really excited about being able to take my IRA and invest it in real estate. So that was intriguing to me. So I signed up for the program, and in that first year did 11 transactions. And although that's great and all, I knew it wasn't going to set us financially free, and it wasn't going to retire my husband. So I figured I needed to figure out what would allow me to scale faster. And that led me to multifamily. So I started listening to as many podcasts as I could, came across Rod Cleef's program and decided to hire him as a coach, and went to that very, very first boot camp that he ever had in 2017, which I met a phenomenal group of people. And it's so fun to go to those conferences because you walk away with so many new relationships to build off of and ecosystems to really dive into and leverage when you find your first deal. So the one thing I took away from that particular thing from that conference was a lot of people love the Kansas City market, and they wanted me to keep them abreast of anything I found here so that they could potentially invest in it. So in my mind, I thought I'm going to be the boots on the ground for whatever I find here in Kansas City. And me and another gal, we underwrote 250 properties over the course of the next year and a half. And finally, I got to a point where I was like, gosh, the saying goes, the definition of insanity, doing the same thing over and expecting different results. And I thought, I can't go another year and a half doing the same thing and expecting I'm going to get a building. I mean, there were too many California investors coming into the Kansas City market and driving the cap rate down. And so the numbers just didn't make sense from a syndication perspective. And they didn't make sense from an investor's perspective. So given that situation, I started looking elsewhere, I went back to flipping homes. And me and another lawyer from the Rod Cleef's group, we connected and we did a ton of homes in 2019. I mean, we had a stellar year together. And our goal was always to move over and pivot into multifamily. And so in 2020, that finally happened.
That's awesome. So the 11 transactions that you had when you first got into it, those were kind of the fix and flips that you were doing at that time?
Yeah, I also bought in an area near a hospital where I knew that there was a lot of young professionals that would be working at the hospital that would want rentals. So I used my IRA to fund a lot of those single family homes. Looking back, I purchased all those in cash 100%, and I didn't leverage my money. Look, I would do things differently today, but now it's 100% cash flow. So my husband's happy about that.
That's awesome. Well,
Yeah.
Let's go ahead and dive into this particular acquisition. It's 72 units out of Northwest Arkansas called Arbors Apartments. So first, talk to us about how you found and how you sourced this particular acquisition.
Okay. So we are in the COVID era right now, or at least for this period of our lives. And over the course of 2020, while I did a few flips, I kind of had in my back of my mind that Arkansas, every time I would take my kids down to go to college there, they were enrolled at the University of Arkansas in Fayetteville. I would notice there was a ton of cranes everywhere. And the highway infrastructures kept changing every time we go down there. And I thought, why am I not looking in this market? And I always resolved that I'm not going to be here long term. My kids aren't going to be here forever. So it didn't make sense since I didn't have eyes there. But once I changed my mindset and said, why not? Why not hire a property manager? It just made sense. So I reached out to a broker, and we met for coffee at a coffee shop. And it was during that conversation, I told him exactly what my experience had been, that I am involved in some other limited partnerships in other properties, and just shared my experience. And from that, he sent me over a deal that was off market. And that was the key, is the fact that I went out of my way. And I think because I was there, taking the time to get to know him probably spoke volumes versus a phone call, in my personal opinion.
Yeah, I'll definitely second that. That there's a lot of these brokers out there, and especially in the multifamily space, that get lots of phone calls and lots of emails from people who are looking for deals and looking to kind of acquire these types of assets. But it's the person that can go that extra level and actually take them out to lunch, take them out to dinner, a cup of coffee, or even just going in and spending time with them, going and touring a property that maybe they're not necessarily looking at acquiring, but they want to spend some time with them, build that rapport with them, and build that relationship. Because just like we talk about investor relations, it's a relationship business. Broker relations is the same thing. It's, you have to build that relationship with those investors, with those brokers, to be able to get some of those kind of pocket listings, if you will, and those off-market acquisitions that can really kind of be a game changer for the portfolio.
Absolutely. Yeah. That's exactly what happened here.
So you, how soon after that particular sit down with that broker did you get the email from him or the phone call about the off-market opportunity that was available?
It was literally that day.
So that day he went back to his office, or she went back to his office and said, "Hey, here's this particular deal that you should definitely take a look at." And you took a look at it. And what transpired from there? How soon after that did you go tour the property? How soon after that did you finish submitting your first offer, and that process from that point?
Well, this is where it's kind of funny, because for the longest time, I thought I used the Michael Blank as a syndicated deal analyzer, as many people do. And for the longest time, I thought my SDA was broke. I thought somehow I changed one of the formulas and it was always just turning red. So it wasn't until on this particular underwriting, it all turned green. And I kind of took a step back and I thought, wait a minute, my syndicator does work. Oh my gosh, this is so exciting. And I had just previously had a conversation with another lawyer that I hadn't talked to in a couple years from that very first boot camp that I had went to. And he said, "Hey, if you get something, let me know. We can practice underwriting together." And sure enough, I called him and we went ahead and we submitted an LOI immediately. So within a day, we had already put together an LOI and sent it in. Now, here's where it gets a little interesting, is that the offer price was $4.2 million on this. Mm-hmm. We submitted an offer of 3.9. And then as we did more investigating and due diligence on it, let me back up. They actually declined our 3.9 offer. But after we did some further due diligence, we went back to them and said, our offer was 3.9, but instead we're going to offer you 3.74. So we went backwards on our offer, even though they had declined us. Mm-hmm. And the funny thing is of course, I jokingly called the broker and said, "Hey, listen, I know they didn't accept the 3.9, but we're really going to have to retract that offer. And here's our real offer. So I'm really sorry, it's the wrong direction. I know he wanted us to come up on our offer, but we got to go down, and here's why." And probably 3 weeks later, I get a phone call and he says, "Hey, I think I can get this deal done, but can you come up $80,000? So I called my partner on this deal and he said, "Listen, we're in COVID right now. We don't know what the future is, and we're not making speculations. We're not speculative buyers, and so we're holding firm to our number. And sure enough, a couple weeks after that, I get a call from the broker to check my email that I have a signed LOI. So it was just a happy day for me, because it had taken me 3 years since that very first boot camp that I went to. 3 years. That's a long time to wait.
So let's unpack that just a little bit here, because you mentioned that you had to go down on your offer. So what were the reasons why you actually went down on your offer there?
So originally the broker had put together an offering or an operating memorandum showing the sizes, and the sizes they weren't true. So we had to go back. I mean, we had already figured out what the sizes were because we had done due diligence immediately after getting the initial numbers on the property. We drove there. We wanted to take a tour and make sure it was something we really wanted to move forward on. And so based on our tour, that's what made us think that, hey, I don't think these sizes are what they're telling us they are. And they were significantly off. So that's what allowed us to go back in there and change our price.
When you talk about sizes, are you talking about the unit mix? Like they were telling you had more 2s than 3s, or was it just the square footage of each one of the units?
Square footage was off.
Okay.
And there ended up being, instead of 2 different sizes, there were 4 different sizes. Corner being different than an inside unit. Mm-hmm. And then that changed depending on if it was a 1-1 or a 2-1.
Mm-hmm. Okay. And so you got a signed LOI back. You're really excited. $3.74 million as the final accepted offer. I'm sure it was kind of like, oh boy, now I have to actually execute on this thing, especially being the first one. I mean, I remember our very first one, how we did it. And it was definitely one of those moments where it was like, oh boy, we got to now start doing what we're supposed to be doing, And, and so I'm sure that was pretty exciting for you, right?
It was. One of the things we learned really quickly is because of COVID, there were new restrictions in place that Freddie and Fannie had put in that required that somebody that hadn't been a GP before had to now partner with somebody that was a seasoned investor that had went full cycle twice on 2 different multifamily properties as a GP. So I was thankful I had selected the right partner on this because he actually had already done that. So he qualified. So we didn't technically have to bring other people in. Now we did for this deal because he had just come off of another capital raise. And being my first deal, I wasn't really sure how much I could raise. But this is where it's so important to keep your network alive, regardless of what path you start going back down in real estate, because people were watching what I had been doing over the last 3 years. So when I finally made the phone call, hey, I've got a deal, they had confidence that I knew what I was doing because I had been posting on other things that I was doing. Mm-hmm. So that helped with the capital raise.
How much earnest money did you have to put up on this one?
We did 1%.
Okay.
Nothing went hard.
Okay. So nothing was hard the entire time?
Nope, not until we got 45 days from, and here's another thing. So we had put in our LOI that we were going to close by December 6th. And then we get the contract from our lawyer, the buyer signs off and sends it back. And as we're looking through the critical dates, it says February. I'm like, why do we have dates clear in February? What's going on? Mm-hmm. Sure enough, and I had to call the broker to make sure that the seller knew he had signed this, but our lawyer was using business days, not calendar days. So when you're talking 45 days, it pushed us out quite a bit further than December, all the way into February. And here we were trying to get closed to, December 6th. Mm-hmm. So our goal was still to get closed December 6th. So we reassured the broker and the seller, hey, that's our goal, is to get this done. But I want you to know that in the event that any vacancies slip, it could push us, and we have the right to do that.
Mm-hmm. Yeah. No, that's definitely a very good thing to kind of add inside of those contracts. Definitely a miscommunication with the attorney and business days versus calendar days, which most real estate contracts are built off of calendar days, not business days. So I'm wondering why they did that. But one of the other things I wanted to talk to you about on here was during this entire process, when you got into the due diligence phase, what are some other things that maybe came up during the due diligence process that might be interesting for us to talk about?
For us, what we really liked about this asset is, although it had mansard roofs, which come down over the sides, and flat roofs, it's not the most appealing building type that you look at. But what we liked about this asset is those roofs had already been redone. The previous owner had already put in $900,000 over the course of their ownership in the last 3 years. So when we were going into it, we noticed that it was just a good, solid asset. For us, on our due diligence, we were looking for meters to make sure they were separately metered. We were also looking at how the water tanks were set up, the furnaces. Did you have any boiler systems? Those are the kind of things, the age of the ACs, that air conditioning units. We were also looking at the laundry room facilities, just everything that they had already done in the last 3 years. We wanted to make sure that it was done well. And then we also, during our due diligence, kept a list of all the things that we planned to do, and we put a budget to the number as we were walking. So we had a really good property manager that had committed to this project if we wanted them to. And they brought a team of 5 people. So they walked every single unit, and we got that done in a very short order because they had so many people, and they kept very good notes that said, here's the findings on every single unit. And for us, it was very, very minor. We were very impressed that a C+ property, I would throw it up against a B class property here in my neck of the woods. It was that well managed.
So not really a lot of deferred maintenance or major CapEx items or anything like that really came up during that process.
No, and the previous owner had already tried to take it from a C class and make it a B or an A- property by upgrading it with granite and stainless appliances, and realized that this tenant mix doesn't support that. Because they're shift workers that work at the Tyson plants and the hatcheries around there. So it just didn't make sense to add that much value to them, because you wouldn't get that rent out of them.
For sure. And what's the age of this property?
This one is it was built in the 70s.
And you said it had been renovated. How recent had it been renovated?
In the last 2 years.
Okay. All right. And what's your business plan on this particular asset?
So ours is just to continue to shore up the inefficiencies on collections. We have a unique situation in which we have a Marshallese population. We are the second largest Marshallese population in the US, and that's behind the Marshall Islands. So one of our biggest issues is really making sure we shore up the collections on that particular population. And thankfully, this new property manager, they have hired on somebody that speaks this dialect, and they already have a plan in place. They've already created a way to make sure they get in contact and can communicate with this segment of population. So for us, it's just, helping with collections, changing out some of the lighting, faucets, door handles, some of those things that make it look aged when you walk into the unit. We're going to change over paint colors. Everybody's going from the golds to the grays. So we'll be converting some of those along the way too. And then we've got some countertops that we might replace as needed.
So do you have a set budget on the interiors that you're spending?
Yeah, so $2,400. And over the next 2 years, we'll do we'll probably do 18 the first year and then 18 the second year.
Okay.
They won't all get touched. They were in very, very good condition during our due diligence.
Okay. And what about the exterior budget? What did you reserve for that?
We budgeted 60,000, and we've got some allocated for signage.
Mm-hmm.
And then a laundry room, we're going to add a split. So we've got heating and cooling in there. And then we budgeted for AC units. The previous owner had already done the majority of the AC units, but we're just anticipating that we'll have to replace some over the course of the next 5 years.
Okay. So this is a 5-year hold as far as your projections are concerned, correct?
Yeah.
Okay. And what about any COVID delays when it came to due diligence or anything like that? Did you have any like restrictions of certain units they wouldn't allow you in, or certain residents wouldn't want you in their units or anything like that?
We actually did not. This was a very, very easy due diligence. Like I said, my partner and I, we walked it just within days after submitting the LOI. And then once it got accepted, once our offer got accepted, we immediately went back with our due diligence and we walked every single unit. There was nobody that kept us out. Mm-hmm. And the only thing that came up is we had to have a survey done, mm-hmm. and the appraisal done. And rather than us turn around and go back to the property, we had the broker meet the banker there, and they were able to allow them into 5 different units. So they wanted to see one of every different unit that we had there on the property. Other than that, it all went very, very smooth.
So let's move into the financing aspects and walk us through kind of what you ended up doing from the finance side of things. I know you mentioned earlier going through Freddie Mac. So walk us through what you ended up doing as far as the finance options.
Yeah, so we ended up going with a broker. It was Old Capital, and they used Freddie. And on that particular deal, we ended up putting together a syndication. Mm-hmm. So in that particular case, we were looking for limited partners. Our goal was to have, increments of $50,000 or $100,000 positioning. We had some though towards the end that ended up doing $25,000, mm-hmm. Because they wanted to be part of the deal. Mm-hmm. And at the very end, we had 4 units initially that were vacant. And then at the very end, we were at 5. But we always stayed above the 90%, which is the requirement in terms of occupancy that Freddie needs to reserve, make that reserve.
And was that 90% physical or 90% economic?
Physical and economic. I mean, it's together.
Okay. So you had like 100% collections on the property.
We were only off that last month. We were off a little bit, which caused a delay in our closing.
Okay.
But our physical occupancy, it needed to be at 90% above on physical occupancy. Mm-hmm. That's where we were. You mentioned something that I wanted to address. Oh, because of COVID, mm-hmm. we had to have 1 year's worth of principal and interest. So we had to have $150,000 on this in reserves.
Yeah, that was definitely going to be one of my questions on the financing side of things, because that's definitely something that a lot of the lenders have been requesting right now. Is not, and even if I'm going to walk through the terms a little bit with this Freddie loan as well. I want to know kind of, what was the AM period? What was the interest only period? Was it a 7, 10, 12 year? Was it fixed or floating? Is any prepayment penalties, things like that? So can you walk us through the terms of the loan as well?
Yeah, so there was a little bit of a glitch. We thought we were getting 2 years interest mm-hmm. only. Mm-hmm. And as it turned out, when we got to near the end, we realized we didn't lock in on that. We did have a interest rate of 3.51. it was going to be a higher interest rate if we took interest only. So thankfully it played out. Our numbers were almost identical. So it really was a wash for us, but we got it's a hybrid loan is what it is. It's a 13-year loan. It's amortized over 20. And then we've got it locked in at 3.51 for 7 years. So because we're going to hold for 5 years, we built into our numbers a 1-year prepayment penalty that we would have to pay off. And so all that figured into there, it all came out very good for us.
What kind of prepayment penalty is it?
It's a step down. Yeah, so I think it's 1%.
Okay. All right. And then on this particular kind of hybrid loan, it's fixed for 7 years. And then after 7 years, if you still have the property, does it go to a floating rate? Is that kind of how it works?
It's actually locked for 13 years. So it's a 7-13 hybrid loan. And so it's locked for 13 years. But at year 7, there's no penalty after that. Okay. Does that make sense?
So what's the hybrid aspect of it is what I'm confused about, because I don't really see anything that's hybrid on. That's a pretty standard kind of setup where you have a certain amount of years of IO, and then you have a prepayment penalty up to a certain number of years, and then it's fixed for at a certain period of time. So what's the hybrid aspect of the loan?
Honestly, I think there were so many variables in terms of we could add interest only if we wanted. We didn't have to add interest only. So I think that was the part that was the hybrid. Mm-hmm. As it turned out, we didn't do that. So I think that's why you're seeing that it's pretty traditional.
Mm-hmm. So did you get any interest only, or was it completely zero interest only?
Zero interest only.
So no interest only. 1 year of P&I for COVID reserve, 20-year amortization, 3.51%, 7-year step down prepayment penalty, and then no prepayment penalty, but it was a 13-year balloon.
Correct.
Okay, good. And you, I know you had mentioned it and kind of alluded to it earlier, but talk to us about kind of some of the delays that happened towards the end of the deal that caused you to have to extend for a few times because I think you originally said December 6th and ended up closing on December 30th. So walk us through what happened through those last several weeks there.
Yeah, one of the things they always say is a big hiccup and that you need to be prepared with is your insurance. And so everybody always looks at how much expense per unit are you assuming when you're doing your underwriting. And we had budgeted at $3,200, and we thought we were very conservative at that. But as it turned out, Freddie wanted us to be at $3,000 per unit. So when you're getting close to the end and you've got to come up with, okay, where's that going to come from, right? We had already went to our insurance company and said, hey, we need to get our number down. And so they did. They worked really hard. They got their number down another $4,000 to $5,000, which really helped us. So we got us to $3,000. But then in that last month, the problem was our collections. You're going into Christmas time, and we've had COVID. It's also year end. There were so many factors going against us. And so we were off by collections. They were showing $5,000. Now, thankfully, we had collections come in on the 7th of December that allowed us to pull that off, and we were only off by $3,000. So at the end of the day, what we had to do is we had to come up with a little bit more out of pocket to meet that number. But we just kept going back and forth. And with people taking vacation, I mean, you've got CBRE, you've got Freddie, you've got Old Capital, and then you've got all of us. And you've got so many players involved, and everybody's taking vacation time around Christmas. It just became a little bit, every day it felt like a new hurdle. But, everybody was on the same page. We're going to get this closed in 2020. And the thing is, when December 1st, we had a conversation with CBRE, and they said that Freddie has said that all loans are done for 2020. They're not going to close anymore. But they did say that ours was earmarked for 2020 and that they were determined ours was going to close in 2020. So we knew we had some hurdles to get over. And we were just everybody was on the same page. We're going to make it happen. We were hopeful we were going to get closed around the 18th, and then that got pushed to the 22nd. And then, just some little sliders because of collections caused us to keep getting delayed.
Mm-hmm. So what was the seller like when you went back to them to try to extend? Was there a talks, or did you have to put up additional earnest money to kind of show the good faith that you were going to be moving forward with this? Or were they just really, happy to go ahead and just extend it without the additional EMD money?
No, as it turned out, our broker was a part of all the collections issues, and he was communicating with the previous property manager. So they knew our intent was to get this closed. Mm-hmm. And I think because the broker that was selling the property was in such good communication with the seller wasn't worried. He never said, hey, we need more earnest money locked down because you keep extending the date. We were never asked. And I think it's because he knew our intentions were good.
Mm-hmm. So the purchase price on this, $3.74 million. We didn't retrade that at all or anything like that, correct?
Nope.
Okay. And what was the equity raise on the overall equity raise from the investors on this one?
So we raised 1.47, which is right there sitting at 25 to 26%.
Okay. And that 1.47 is taking care of the down payment, the closing costs, as well as any of the fees associated with the syndication.
Correct. And it includes the reserve as well, the 150 in reserve.
Correct. Okay. And so you're raising 1.47 million. Go. How did you raise the 1.47 million from your investors? Did you do a 506 Bravo? Did you do a 506 Charlie? How did you actually end up kind of reaching out to those investors to get them to pony up and actually invest in you?
Yeah. So we had a 506B. So that meant friends and family. Mm-hmm. And so the very first thing we did, as soon as we got clearance that we had kind of locked in on our rate, we put together a video and we sent stuff. I mean, we all reached out to our friends and family and said, hey, we've got an offering here. If you would like to know more about it, we're going to be doing a webinar to showcase this particular offering. And so that's what we did. And then we started making phone calls to all the people that we had reached out to, but hadn't responded. And that's when you really figure out, okay, all those coffees you had and these, multiple conversations on the phone, letting people know what you're doing in real estate, that's when these all pay off. Because then you find out exactly, do people even have money? You find out what their investment criteria is. You learn a lot during those phone conversations. So I think my biggest takeaway was you have to always assume you're going to have another deal coming. So you should be having as many conversations with as many people all the time.
No, I totally agree with that. And I think a lot of times people will focus too much on finding the next deal. And then they get that next deal and they're like, oh, I have to have investors as well. And now it's too late because you now are behind a time frame and a time clock of you got to get the money in by a certain period of time. And it's a process where you should be putting that in place ahead of time where you're finding investors and finding deals, all at the same time so that you're ready for both of them whenever they come available.
Absolutely. That's good advice.
How many investors did you have in this deal?
We're sitting at 28.
28 investors. And let's see. So average investment on here is just over 50,000. So 52.5. Mm-hmm. 28 investors, 52.5. And what was you said the smallest investor was 25,000. Is that correct?
Mm-hmm.
And then what was the largest investor on this?
100,000. We had several of those.
Okay, 100,000. And your minimum investment that you had advertised was 50?
Yes.
Okay. All right, good. And how long did it take you to raise the full 1.47 million to be able to close?
We didn't do our webinar until November the 16th, going right into Thanksgiving, which I wouldn't recommend to anybody. It's hard to reach people if they weren't on the webinar. It's because they were traveling, and a lot of people like to hunt around Thanksgiving as well. We learned that. Mm-hmm. So it took us 3 weeks to raise that.
3 weeks. That's good. That's awesome, especially for your first project. And you said that were there other partners that were on this project with you?
Yeah, we brought in some other warriors to help us. Mm-hmm. Like I said, Ed, my partner, had just come off of another deal that he had mm-hmm. just raised capital for. And so he wasn't for sure, if he would have enough people that would want to step up to this one as well. Mm-hmm. So we brought in a couple other people to help us out.
Mm-hmm. Okay, great. So can you think of anything else throughout the entire process that maybe happened, whether it be good or bad, that might be interesting for us to talk about that would be beneficial for the listeners?
I would say, for me, I saw a lot of overpaying on assets over the last 3 years. Mm-hmm. People were willing to pay for the upside. Mm-hmm. And I think that there was a lot of doors closed for me because I wasn't willing to pay for that upside. Mm-hmm. So I think the biggest thing is you don't know the future. Nobody saw COVID coming. And so I would just assume that I think everybody should, in their underwriting, plan for the worst case scenario, mm-hmm. And know how far can your vacancies drop or collections drop, and you can still meet your note. So mm-hmm. we can drop all the way down to 63% and still meet our debt service ratio. Mm-hmm. So that makes us feel very good because, we're assuming the vaccines are all going to go out and there's nothing else bad coming, but you don't know, right?
Yep. No, that's definitely true. And it's one of those things where you always have to plan for the worst, whether you're in a COVID environment or not. So you always want to make sure you have ample and operating reserves. So one of the things that we do with our acquisitions is we always make sure we have at least 4 to 6 months of operating reserves, where if the property went down to 0% occupancy, we can continue to pay that debt service, not just the debt service, but the debt for a service plus the expenses of the property for 4 to 6 months, which the likelihood of it doing that is not very high. But we always, again, want to plan for that worst case scenario just to make sure that we have those extra operating reserves in place. Because like you said, you never know when things like that are going to happen.
Wow. That's great advice. You're the first person I've ever heard that does that. So that's awesome.
Yep. So I have 2 final questions for you as we wrap up the episode today with you. And they're contrasting questions. And the first question is going to be kind of geared towards, what did you find was easier during this entire process that maybe originally you thought was going to be a little bit more challenging?
I found capital raising to be way easier. Mm-hmm. And I think it's because of all the conversations I had and the different social media postings that I'd made on real estate. So mm-hmm. I really didn't realize how much people watch what you're doing. And so I would say, if you're out there doing things in real estate, let people know what you're doing. Don't be scared to not post and think, oh, people don't care, people aren't watching, because they are, and it'll pay off when you go to capital raise. Mm-hmm.
And the final question I have for you is kind of the opposite of that. What did you find that was a little more challenging than you had originally expected?
I didn't expect that we would have an issue with collections in the last month. I mean, I really thought that we were once we raised our capital, I didn't expect there to be much more. Mm-hmm. And that's when we had hurdles that we had to jump, and our broker had to get involved with the previous property manager. had to, really figure out, okay, where are collections at? Are we getting any extra funds? What can we anticipate between now and when we close? How much more can we collect? So I didn't anticipate any of that. So I have a bigger awareness now going into it on my next deal.
Sure, sure. Well, Jen, how can the listeners reach out to you if they have further questions for you about maybe this particular acquisition, want to dive into it a little bit deeper, or maybe they want to follow you and maybe connect with you and potentially invest with you on one of your future opportunities that you have available?
Oh, well, thank you. They can find me on LinkedIn. Jennifer Barner is the name again, and that's with an R at the end, not an S. So it's Barner. You can also find me at lighthouse-ventures, and that's plural.com. You can also go to Jennifer at lighthouse-ventures.com. That's my email. And then a phone number is 913-481-8221.
Awesome. Well, I want to thank you so much for joining us today and sharing all of these different kind of insights on this particular acquisition that you had. And, there's this thing called the law of the first deal. You've done this first deal now. So I expect in 2021, you'll probably hit another couple of deals. So as you continue to progress and grow and close more deals in 2021, looking forward to having you on some future episodes as you continue to close those more deals.
Well, thank you. It's been an honor, and I'm grateful for the opportunity to share it. So thank you.
Awesome. Thank you so much.